you know, late January 2026 delivered this absolutely brutal financial whiplash. I mean, 1 minute gold is sitting at a record-breaking $5,600 an ounce, and then days later, the floor just caves in.
Oh, yeah, an absolute free fall. I mean, we saw 15 to 20% just wiped out, dragging prices straight down into the $4,800 range.
Right, exactly. And looking at the market research and trading logs for today's deep dive, it honestly looked like the market completely detached from reality overnight.
It really did. And, if you're a long-term investor trying to navigate this volatility, it's terrifying, which is why our mission today is to cut through that panic and explain the actual mechanics of what happened in a really accessible way.
Yeah, to sort of make sense of the chaos. Like, think of the gold market heading into 2026 as this really high-stakes poker game, right? Half the table is playing with money they borrowed from the casino.
Yeah, they're leveraged to the hilt.
Exactly. And suddenly, the House demands everyone prove they actually have the cash in their wallets. And if you don't, they just instantly cash out your chips.
Well, the House definitely called in the loans here, but that poker game didn't just end randomly. You had two massive catalysts hit the table back to back.
Right. So what was the first one?
The first was basically a macroeconomic earthquake. So Kevin Warsh gets nominated as the new Federal Reserve Chair.
Oh, right. And the market immediately reacted to that.
Instantly. The market read that as a rock-solid guarantee of higher interest rates for much longer, and alongside that, a surging U.S. dollar.
Which makes sense because, gold doesn't pay out a dividend or yield. So higher interest rates make sitting in cash or bonds look a lot more attractive.
Yeah, exactly. Plus, gold is priced in dollars globally, so a stronger dollar inherently makes it more expensive for the rest of the world to buy.
Okay, so that macro shock was the first punch. But the knockout blow was a lot more mechanical, right? Like this massive speculative washout.
Oh, the washout was brutal. During that monster rally in 2025, traders got heavily overbought. I mean, they were funding their positions with just huge amounts of leverage. And seeing the mounting risk, the exchanges finally stepped in and raised margin requirements.
Wait, let's break that down for a second for the listeners. The margin is essentially the security deposit you need to hold those leveraged loans, right?
Right.
So the exchanges suddenly demanded a much bigger deposit.
Precisely. And if a trader couldn't wire that extra cash immediately, well, the exchange automatically sold off their gold to cover the bet.
Wow, so they didn't even have a choice.
None at all. And that initial wave of selling drove the price down further, which then hit automatic stop-loss orders.
Triggering even more margin calls.
Exactly. It created this vicious, self-feeding cascade of forced selling. I mean, it had absolutely nothing to do with people suddenly hating gold and literally everything to do with a sudden lack of liquidity.
But wait, hold on a second. Gold has this reputation as the ultimate untouchable safe haven asset. You buy it when things get shaky.
Right.
So how does simply naming a new Fed chair and tweaking some deposit rules override that fundamental safety? Like, why does that trigger such a violent cascade?
Well, because in a highly leveraged market, the mechanics of forced selling don't care about an asset's long-term reputation.
Ah, I see.
Yeah, when you get a margin call, you don't sell what you want to sell. You sell what you can. That safe haven status just couldn't stop the cold, hard math of over-leverage.
Okay, so the casino kicks out the borrowed money players. But despite those terrifying $100 to $200 daily price swings we saw, the market never actually broke.
No, it didn't. It caught itself and stabilized right around that massive psychological barrier of $5,000.
And why did that specific floor hold?
It held firm because the underlying structural drivers for owning gold, I mean, things like geopolitical fracturing and ongoing trade wars, they were still very much in play.
Right, the real-world anxieties didn't just vanish.
Exactly. So we saw intense, aggressive dip buying from major players the second the price dropped below $5,000.
And because of that massive wave of buying, gold actually finished the month of February up 5%, which is wild. So looking at the dust settling, does this mean the gold market is finally maturing, like shaking off the pure momentum hype to behave like a disciplined, macro-driven asset?
The data points to exactly that. February wasn't the death of a bull market at all. It was a violent but, very necessary reality check.
Yeah, a total reset.
Right. We watched gold transition from running on pure speculative sentiment to actively responding to real factors like interest rates, dollar strength, and global liquidity.
It graduated, basically.
It really did. It became a serious macro asset again. The froth was cleared out, and it left only the bedrock demand.
That makes a lot of sense. Well, I want to leave you, the listener, with a thought to mull over as you look at your own portfolios. If gold can endure a catastrophic leverage washout and a sudden aggressively hawkish shift at the Fed, yet still finish the month up 5%, what does that sheer level of underlying resilience tell you about the true global anxieties of the central banks? They keep quietly buying it all up. The speculators might have been forced away from the table, but the heavy hitters are just buying the casino.